Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me live from the market site in Times Square, New York City, we have Phil Mackintosh, chief economist at Nasdaq. We're going to talk about the troubles in China and if that really is the straw that broke the global equity rally's back. It's quite the mouthful, Phil. And really the question is this something that is breaking that global rally back, or is this something that has kind of been festering in the background for a while in terms of Chinese markets and performance?
Yeah, I mean, I think obviously we're going to talk about Evergrande more today, but in reality, there's been quite a lot of changes happening in the Chinese economy for a couple of months now. You look at what's happened with Alibaba and Ant, Tencent, all of the new data privacy laws that the Chinese government's been trying to implement. The big CEOs have had their flexibility constrained. So there's been a lot of changes in the Chinese economy and how the corporate structure and the sort of capital markets work in China. Arguably, we could say we've seen this coming for a few months, but really Evergrande is a slightly different problem.
So why is Evergrande spooking the markets as much as it is?
Yeah, so Evergrande is obviously a property developer, and they've had a property bubble in China. Evergrande has about $300 billion of liabilities, and at the moment it doesn't have enough cash flow to actually pay its bonds interest payments. So it's going to default on bonds potentially. It already has a couple of days ago. The risk is that because the property market is in a bubble, it's a bit like what we had a decade ago with Lehman and all of our property bubble, that you could see a capitulation where the losses of Evergrande trigger losses in financial companies, which trigger more broad-based losses, maybe property owners, households start to lose money, and that could be a much bigger problem for China to constrain.
Right, and it's so interesting. This month marks 13 years since the Lehman collapse. I mean, we were talking the other day about 9/11. Wow, it's 20 years. Lehman, it's 13 years. How fast time really does move here. But is Evergrande like Lehman, or is it not quite as systemic?
Yeah, I don't think we know right now, and the general consensus at the moment is it's not quite as big and it's not quite as systemic. But you think about Lehman, it was reportedly about $140 billion worth of bonds that they defaulted on. At the moment, Evergrande is defaulting on $20 billion worth of public bonds, but it's obviously got much more liabilities. Some of those liabilities are offset by assets, but if you look at the price of their bonds in the market at the moment, they're pricing at about 30% of face. So that's only $100 billion worth of assets backing $300 billion worth of debt, if that's sort of the math that you're using. So it could be a pretty big default, but we've got to wait to see how it plays out, whether it's just a cash flow shortage, what the underlying assets really are, and how interconnected Evergrande is into China's financial system and the world's financial system.
Phil, it's so interesting. Traders are like, okay, we need to identify a specific moment where we're going to get to that correction because we haven't had one in so long. So it's almost like a self-fulfilling prophecy. But there are other things going on in the world besides China that, it's a perfect storm of where it could be not just one thing, but a number of others, particularly here what's happening in the U.S.
Yeah, so obviously the big sell-off that we've had in the last week was with everybody worrying about Evergrande. But there's, like you said, there's other things going on. There's the debt ceiling discussion that's happening in the US now. And we know last time we had a lot of debt ceiling discussions. The equity market sold off quite strongly as well. We've got a potential for a taper tantrum with the Fed meeting and talking about when they're going to start to taper, which means buy less bonds and eventually stop buying bonds and start putting interest rates up. So the last time that happened, we had a bit of a sell-off in equities too. So there's definitely some headwinds and risks out there.
All right, Phil. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.